I can't go back to all what I have said. God forbid bad thing. Okay, so the next one is statement of um the next one is statement of financial position, which shows what is the asset and liabilities position as well as equity position of the company as at a particular time period of time, the 31 December, which is the common one of the year. The next one is the statement of cash flow, which shows the movement in our cash balance, how we move from what our cash balance is at the beginning of the period to what it was at the end of the period. And we use that to measure the liquidity of an entity. The next one is statement of changes in equity. That shows how our equity balances move from the beginning of the year to what it is at the end of the year. Having said all of that, a statement of the financial statement is prepared in the same format we are used to, so that there will be it will be a little more concise, because we don't want the financial statement to be unnecessarily bulky, and we keep most of the information necessary in our statement, in our notes to the account. The notes to the account is where we give detailed information about what transpired during the period. So without wasting our time, because I will not want to keep us here for too long, I will not want to keep us here for too long. So we can quickly go into this question and call it a time. So would someone volunteer to read for us? Will someone volunteer to read for us?
The following trial balance was extracted from the books of Adama PLC as at June 30th, 2022. All figures are going to be correct. So please scroll down. Additional information. 1. The value of the freehold land and building includes the land element of 266,800,000 and the estimated remaining life of the building at July 1, 2021 was 25 years. Depreciation on building is charged 65% to cost of sales and 35% to admin expense. The revenue includes 69,250,000 for an item of office equipment disposed on November 30th, 2021. The equipment had a carrying value of 46,060,000 at the date of sale. The equipment cost 75 million when it was acquired 3 years ago. Included in the cost of sales is 82.6 million incurred in the manufacture of a new office equipment, which was put to use by Adama PLC on February 1, 2022. All office equipment is depreciated at 15% per annum using the reducing balance method and charged to cost of sales, while depreciation of all motor vehicle is at 20% per annum on straight line basis and charged to distribution costs. Depreciation is to be charged in full in the year of acquisition and not charged in the year of disposal. Following the conclusion of the winding up proceeding on one of Adama PLC customers, it was resolved to write off the sum of 26,450,000 due from the customer and to make allowance for doubtful receivable of 2.5% on the continuing trade receivable. The financial assets are equity instruments held at the fair value through profit or loss and have suffered impairment loss of 12,700,000 at the year end. The 3% redeemable loan note was issued on October 1st, 2021 under terms that provided for a large premium on redemption in 2025. These terms were interpreted by the finance director to mean that the loan to mean that the loan notes have effective interest rate of 6.5% per annum. The income tax expense for the year ended June 30th, 2022 is estimated at 143,552,000, while the deferred tax payable for same period amounted to 12,520,000. There was an overprovision of 25,664,000 in respect of income tax for the provision for the previous trading year. The surplus account balance represents the corresponding credit entry for shares issued as premium of 15 kobo per share, arising on issue of 400,000 ordinary shares made during the year. The directors recommend the 20 kobo final dividend per ordinary shares for the year and to transfer 38,900,000 to general reserve. Required. So please scroll down. Required. Prepare for Adama PLC the following financial statements. 1. Statement of POL and other comprehensive income for the year ended June 30th, 2022. Statement of changes in equity for the same period. Statement of financial position as at June 30th, 2022.
Okay, thank you very much. So from all what we have read so far, realize that the question is a bit packed with additional information spanning across the likes of IAS 16, IAS 16 and IFRS 9, IAS 12, and so on and so forth, with some other little adjustment we have to do here and there for some transactions. So let's hope we'll be able to quickly deal with this within the next few minutes. However, feel free to call my attention to anything you don't seem to understand in this as we walk. So I'll start with, we have the books of Adama PLC. Adama PLC. What color should I use? What color should I use? What color should I use? Boom. Adama PLC. Okay. Statement. The first requirement is for us to prepare statement of profit or loss and other comprehensive income for the year ended 30th June. Statement of profit or loss for the year ended oh sorry, we have another comprehensive income. June 30, 2022. So we have Naira in thousands, notes. Then, so to prepare our this thing, we feel we go this route. We start with the notes first so that we don't miss out on anything that needs to be adjusted. So we start with note 1. The first additional information says the value of freehold land and building includes a land element of 266,800,000 and the estimated remaining life of the building as at July 1, 2021. July 1, 2021 being the beginning of this period we are preparing for. You know, if we are preparing for the year ended 30th June 2022. It would have started 12 months before, which is 1st July 2021. And the estimated remaining life is 25 years. Okay. So if we are to all of that information, the basic thing we need to do with it is to calculate of the building. So, but if we look at the trial balance, we were given freehold land and building at valuation to be 165 million, 165 billion 600,000, 1,065,600,000. So to calculate depreciation on building, it will be what? 1,065,600. So we don't depreciate land. So we have to take out the land elements of the cost, which is 266,800. By taking this out, we get the building cost. This building cost is now what we will divide by 25 years to know what will be the depreciation charge for this year only. And that will give us how much?
That's
Seven.
31,952.
31,952. So of this 31,952, they now told us 65% is to be taken as to cost of sales, and cost of sales portion will be 65%, 65% of 31,952, and then admin expenses will take the remaining 35% portion, and that will give us how much? Figure.
Cost of sales 2769.
2769.
Yeah. Admin 11183.
11,163.
8183, not 6.
183.
Yeah.
Okay, that's that. Can move to the next additional information. So the next additional information we have, the revenue includes 69,250,000 for an item of office equipment disposed on November 30, 2021. Equipment had a carrying value of 46,060,000 at the date of sale. The equipment cost 75 million when it was acquired 3 years ago. So we'll say, first thing first, in line with the principle of IFRS 15, the disposal of an item of PPE cannot be recorded as revenue. Revenue is what we make from activities in ordinary course of business. So we'll say revenue trial balance figure. What do we have for revenue based on our trial balance? 2,142,819. Less proceeds from disposal. Proceeds from disposal, which is 69,250. And that will give us how much? Figure, please.
2,073,569.
2,000,000
and 73,073,569.
569. So
Yeah.
since we have a disposal, automatically we know there will be either a gain or loss on the disposal. So we have to calculate gain or loss on disposal in line with IAS 16. So the gain or loss on disposal will be disposal proceeds, which is 69,250. Then less carrying amount of the assets. The carrying amount of the asset at the time of disposal is 46,060. And with this, the gain or loss on disposal is how much? That's the gain. Gain on disposal. This gain on disposal,
23
23
one night.
190. Okay. So note 4, we have what? We were told that included in cost of sales is 82,600,000 incurred in the manufacture of a new office equipment which was put to use by Adana PLC on February 1, 2022. Manufacture of a new office equipment shouldn't be part of their cost of sales, it should be capitalized. So we need to correct that from the cost of sales. From the cost of sales. So we can say cost of sales. So our balance figure is 995 003. Then less cost of equipment, which is 82,600. And with this, we have how much? Okay, so because we are adjusting cost of sales to avoid adjusting and readjusting, let's just take, they've told us that in the next note, they told us that the depreciation on office equipment, which is the category of this one, is on reducing balance method and it is charged to cost of sales. So best thing is to leave note 4 opened and go to calculate the next thing. So I'll leave note 4 open because I'll still have other adjustments coming into it. So I'll go to the next one and say, if we're taking that out, we're told that all office equipment is depreciated at 15% per annum using reducing balance method and charged to cost of sales, while depreciation of all motor vehicles is at 20% per annum on straight line basis and charged to distribution costs. Depreciation is charged in full in the year of acquisition and no charge in the year of disposal. What does that mean? To calculate depreciation on office equipment now, we will have what? The balance figure for depreciation on office equipment, or let me say cost. cost 865 800 less less disposal. Since they said no depreciation is charged in the year of disposal, or less the cost of the one that was disposed. Or since we are using reducing balance method, we can easily do it this way. Less accumulated depreciation at the beginning of the year. Accumulated depreciation at the beginning of the year, which is 199 800. This will give us the carrying amount at the beginning of the year. The carrying amount at the beginning of the year will be how much? Then we can now less the carrying amount of the one disposed. The one disposed has the carrying amount of 46,060, since it's not to be depreciated for the year, since that's the year of its sale. What do we have?
666.
666,000, right?
Yeah.
So we less the one disposed and add the acquired one. How much do we have? The acquired one is 82,600. So what do we have?
7025.
7
025 40.
702 540.
Yeah.
That's the carrying amount for the year. That's the carrying amount for the year. Depreciation rate is how much? Depreciation rate is 15%. So therefore, the depreciation charge will be how much? 15% of 702,540 is how much?
105,381.
702,540. 105 what?
105
381.
381.
381. So this is like the easiest or best presentation I think I can come up with. However, I can as well do it this way and say the existing asset cost is 685 800 less the existing asset cost is 865 800 less the cost of the one disposed 75,000, and this will give us seven what? 790 800. This will be the cost of the remaining assets they are yet to sell. Then accumulated depreciation for it at the beginning of the year is 199 800. There will be an accumulated depreciation on the one that was disposed also. If the cost is 75,000, and is having a carrying amount of 46,060, the difference would have been its own carrying amount, and that will be how much?
28,914.
28,940. If we deduct that from the carrying amount of the entire asset, it means it will remain one what? 170,860. With this, we'll get what? We'll get the carrying amount of the old assets to be 619,940. And if we apply 15% depreciation on that, that will give us how much? 92,991. The new asset, 82,600. They said we are charging full year depreciation, and that will give us how much? 12,390. So if you add it up,
This one you're calculating is
I'm
for
with
what?
you.
This one that you're
I'm
calculating here.
just trying to
Okay.
break it down. So it
Uh,
will still be 105,381. But it is somehow easier this way because there is full year depreciation charge in the year of acquisition, none in the year of disposal. But if they did not give us that clause, that full year depreciation is to be charged in the year of acquisition and none in the year of disposal, we have to follow the provision of IAS 16, which is depreciation will be charged on a time apportionment basis. And if we are to charge depreciation on a time apportionment basis, where we are using reducing balance method, we have to separate it. The one for existing will charge full year depreciation. The one they just acquired, we will need to apportion the depreciation. This one that they even acquired February, March, April, May, June. That's just 5 months. The one they dispose in November 30, we'll have to charge only what? From July, August, September, October, November. That's 5 months also. So we'll have to calculate their depreciation separately and add it all up to know what the depreciation charge for that year will be. Both the depreciation charge on the one disposed, on the one acquired, and the one existing will make up the depreciation charge for the year. But the depreciation charge on the one that is disposed during the year will no longer be part of what we'll be recognizing as accumulated depreciation at the end of the year. It will be written off. So that's just to clarify that. Okay? So since they told us the depreciation charge on it, on office equipment is charged to cost of sales. It's charged to cost of sales. I'll take it to cost of sales. So we have depreciation on office equipment. 105,381. But don't in our note 1, we have charged depreciation on building also. Depreciation on building 2769 is to come here. Then, having done that, we are told that depreciation on motor vehicle is charged at 20% per annum on a straight line basis. So we can come here and say note 6, depreciation on motor vehicle. And that will be 20% of, if it's straight line, we are charging on cost. So delivery van, motor vehicle and delivery van is the same thing, 301 for, and that will give us what? 6280. Is that it?
Yes, sir.
6280. So we are taking this to distribution cost. No problem. We are coming back to that. So we move to the next additional information. Following the conclusion of the winding up proceeding, one of Adama PLC customer, it was resolved to write off the sum of 26,450,000 due from the customer. That's a bad debt written off. No issue. And to make allowance for doubtful debt of 2.5% on continuing trade receivables. Okay. So for this, we'll have what? Let me just quickly scan to. I don't think we have any other thing affecting our cost of sales. So we can close this now. What's the summation? Note 7.
10
10
38
38
553.
553. Olamide, is that you?
No, I mean not.
Okay. Allowance for doubtful receivables. So to calculate our allowance for doubtful receivables, they say that should be 2.5%. That will be 2.5% of how much we have our receivable to be. We have the receivable to be 579,065. Remember, receivables is an asset, so that's the one that would have been on the debit side. Payables, that is a liability, that will be on the credit side. So if that is 579,065, but we can, inclusive of it will be the receivable they want to write off, 26,450. But please, let's pay good attention to the examiner choice of words in the exam hall. If this 26,450, which is the bad debt, is already in the trial balance, that means they've already deducted it from the receivables. Don't go and deduct it again. But if it is in additional information, it means it is here to be treated. And the double entry for bad debt will be to debit bad debt account and credit receivables account. That's why we are taking it out. And you cannot be creating an allowance for doubtful debt on a debt that is already bad, on a debt that is already irrecoverable. You can't say you are creating allowance for a debt that is no longer recoverable. That's why we have to deduct it before we calculate the 2.5%. And that will give us how much? That will give us how much? Hello?
That's 13,815.
13,815. So when we have this, we have to go back to our SOPL and check, do we have allowances in the previous year? Do we have any allowance brought forward? So we check here, allowance for doubtful debts brought forward. So I can't see any of it here. That means this is the first year we are creating the allowance. So no issue. This is the first year we are creating the allowance. We don't have issues with it. We'll take it as an expense and also take it as a valuing asset. But if this is not the first year, then we would have need to calculate what is the change to our allowance. If it is increasing, the increase in the allowance, that is the difference between this figure we just calculated and the figure in the trial balance. If the figure in the trial balance is lesser than this figure we just calculated, that increase is what we'll take to our SOPL. While this figure we just calculated is what will go to our SOFP, which will be deducted from our receivables. But if the figure we have in our trial balance is higher than what we have just calculated, then the difference, which is a decrease in it, will go to other income. Why the figure we just calculated is what will go to our statement of financial position as reduction to our receivables. The reason for that is,
Can you that please?
what do you say?
I said you should repeat what you just said now, and I get it.
When you calculate your allowance for doubtful debt, whatever you calculate is the balance of your allowance at the end of the year. That is what we are expecting, that at the end of this year, this is what might not be received, what we might not receive out of our receivable. Now, whatever the figure is, you compare it with what you have in the trial balance. Though in this case, we don't have anything in the trial balance. But if we have a figure, let's say we have a 12,000 in the trial balance, and we've calculated 13,815, that means our allowance is increasing by 1,815. That 1,815 is what we'll take to our SOPL as an expense, usually an administrative expense. And this 13,815, we'll use it to reduce our receivable when we are recognizing receivable in our statement of financial position. But if the one in the trial balance is 15,000 and the one we just calculated is 13,815, it means our allowance is reducing. The difference between that 15,000 and this 13,815 will take it to our statement of our other income. In our statement of profit or loss is a reduction to allowance, and we treat it as an income because the early allowance we charge, we treated it as an expense. So it's just like we recovering part of the excess expenses you have charged. So why this 13815 is still what we'll use to reduce our receivables when we get to the statement of financial position. Is it clear now?
Yes.
Is it clear? And if you get confused at any point, just draw your ledger. Whatever you have in your trial balance will be your balance brought forward. On the credit side, a provision will always have a credit balance. What you have just calculated is your closing balance on the debit side. Then the difference between it, if this side is more than this side, then your SOPL will be here. If your SOPL is here on the credit side, that means in your SOPL itself, it will be on the debit side. That's an expense. If your SOPL is on the debit side here, in your SOPL, it should be credit. That's an income. So that's how we do it. But because this one is new, like I said, with the figure you just calculated should be your closing balance. Abi? If this figure is your closing balance, if this new figure you have is your closing balance, so balance brought forward is nil. Balance carried down is 13815. What do we say we do? The difference will be your SOPL, 13815. So this way you can balance the accounts. Are we getting it? Are we getting it?
Yes. Yes. This is more explanatory.
Okay. So we have this. While this is sorted, we move to the next thing. So don't worry, I'll just leave this here. Let me leave it allowance for doubtful debts. To be candid, I prefer using journal to adjust than all this calculation because it makes our understanding of journal entries and accounting entries deeper, but it is what it is. We have the financial assets are equity instruments held at fair value through profit or loss and have suffered impairment loss of 12,700 at the year end. For those of us that have done financial instrument IFRS 9, will understand that the impairment loss will be charged as an expense in the statement of profit or loss. So no issue. The only this thing that will be there is that we come here and look at the financial assets 224,200 and come and say financial assets. So our balance figure is how much? 244. That's 244,200. Then with less impairments. So majorly, if it is assets or liabilities, the figure you are given in the trial balance will most likely be opening balance, except those they would have worked on during the year, like receivables, payables. Aside those ones, others would most likely be the opening balance. So this is opening balance. 12,700 is the impairment. So the closing balance now should be how much? 231. 231 what? 500. No problem. We move to the next one. The 3% redeemable debenture, redeemable loan note was issued on October 1, 2021 under terms that provided that for a large premium on redemption in 2025. These terms were interpreted by the finance director to mean that the loan notes have effective interest rate of 6.5% per annum. For those of you that have done financial instruments, you will realize that when the effective interest rate and the nominal interest rate differs, what it only means is that we are shifting the interest we are supposed to pay to a later date. So why this thing has an effective interest rate of 6.5%, but a nominal interest rate of 3% is because they don't want to pay the interest on it, they don't want to pay higher interest on a yearly basis. So they now agreed, or they come to a terms that they will redeem the loan note at a premium, meaning that interest they did not pay over the while instead of them paying at 6.5, they were paying at 3%. All of it will now be embedded in what they will be paying as redemption amount, redemption premium. So, but it's fine. What we just need to understand is that for our SOPL, we'll be calculating the finance cost at the effective interest rate, not at the nominal interest rate. Not at the nominal interest rate. So that means interest on loan notes, finance cost, interest on loan notes will be, the interest on loan notes will be 6.5%, which is 6.5% of. So we'll come back to the SOPL to check our loan notes. We have 3% redeemable loan notes, 843,000, 843,000. And that will give us how much? That will give us how much? Hello?
54795.
54795.
Mm.
So then okay, so that's the finance cost. That's the finance cost. But to now get our accrued, because as you can see, if I'm coming, fifty-four seven nine five. 54,795. Okay, so sorry, they told us the loan note was issued on what date? On 1 October 2021. And don't forget, this our home financial year started with July 1, 2021. That means the loan note interest will not be for the entire year. It will not be for the entire year. October to June will be how many months? October, November, December. Then that will be 9 months. So multiply the figure by 9/12. What do we have?
That's 41,096.
41,096. 41,096. That's the accrued interest. That's the accrued interest on the loan notes. Are we getting it? However, note 10, the 3% redeemable loan notes we haven't come to the end of year one, so the 3% redeemable loan notes will be okay. Um, okay, so I'm sorry. Oh. So the interest on the loan notes we calculated is 41,096. But if you look at our SOPL, you'll see that the interest on loan notes we were given is 14,763. This 14,763 is the amount, is the interest that has been paid. Is the interest that has been paid. So if we do 3% of the 843,000, most likely that's what they have paid so far. That's what they have paid so far. They've only paid for um they've only paid 14,763. So what do we do? We'll do we'll keep the remainder as accrued finance cost. Accrued finance cost. So what will be our accrued finance cost? Accrued finance cost. We'll have what? Finance cost on the loan is 41,096 less the payment, the interest on loan notes. Interest on loan notes 14,763, and that will give us how much? How much will be our accruals?
26,333.
26,333.
333.
Okay. So with that, we can move to the next thing. We were told that the income tax expense for the year ended is estimated at 143,552, while deferred tax payable for the same period amounted to 12,520. There was an over provision of 25,664. So we'll have note 11, tax expense. The tax expense for the year will be what? Current year provision. Current year provision 143,552. Previous year over provision. Previous year over provision is 25,664. 25,664. We'll deduct that because if we have over provided, that means what we charge as an expense so we deduct it now so that we can reduce what we'll be charging as an expense in the current year. Then increase in deferred tax. Increase in deferred tax is how much? They told us the deferred tax payable for this period is 12,520. So that means there was an increase in deferred tax. If it wasn't, if they have told us the deferred tax recoverable or receivable for the period, that means there is a decrease in it. So we would have deducted that. So with this, what do we have as the income tax expense for the year?
130,408.
One
One
130,408.
408.
Okay, so having done that, we were told that now one thing about this. Okay, so the suspense account balance represent the corresponding credit entry. Or before I do that, let me just quickly deal with this. If you look at the trial balance, we were given what? Deferred tax at the beginning of the year to be 100,078, and they've given us deferred tax payable for the period. So to calculate the deferred tax balance now, we'll have what? Deferred tax. The trial balance figure, which is the opening balance, is 100,078. Then okay, charge for the year the deferred tax charge for the year is what? 12,520. So that will make our deferred tax balance to be how much? 112,598. Okay, so we can now go to the next additional information. We can now go to the next additional information. Okay, so we have this. The suspense account balance represents the corresponding credit entry for shares issued at a premium of 15 kobo per share, arising on issue of 400 million ordinary shares made during the year. Okay, so for this, what they are just telling us is that when they sold the shares, the money they received, while they were debiting it to their bank accounts, maybe the accountant doesn't know where to credit. They credited it to suspense account, and this is it. So how do we now correct this? Share issue, proceeds from share issue. Say proceeds from share issue. So since they already told us that they issued 400,000 shares, what will go to their share capital account will be 400,000 shares multiplied by what is the nominal value of their share. Their ordinary share is 50k each. So that means the nominal value is 50 kobo. So we'll say multiply by 50 kobo, and that will give us how much? That should give us 200,000. Abi? Hello?
Yes, sir.
Okay. So then the share premium, which is 400,000 shares, multiplied by 15 kobo. That will give us how much?
60,000.
60,000. Okay. So what this means is that, so they said is represent the corresponding credit entry for shares issued at a premium of 15 kobo per share for the issue of this. So now this 200,000, you can see what we only have here is 60,000, right? That means this 200,000 has already been recorded. It has already been recorded. So that means that one has already been taken to the share capital account. The only thing they are
Sorry,
yet to record is
Mr.
hello,
Goodby, sorry. Want
I'm with
to
you.
sorry to bring back. This tax expense. He said increase in
Yes,
deferred tax, but they gave us deferred tax in our trial balance now.
yes. But at what date? They gave us as at 1 July 2021.
Yeah.
And what they told us here is what? Please, can you mute your mic? They said the deferred tax payable for the same period. The deferred tax payable for the same period. That is what is payable within this period as deferred tax. If that is what is payable for this period as deferred tax, if that is what is payable for this period as deferred tax, that means our deferred, the deferred tax payable will be deferred tax liability is increasing. Our deferred tax is increasing. It is increasing. It is increasing. So that's why we are taking it as increase in deferred tax. Is that clear now?
Yes,
And
sir.
that's why I've proceeded to say if they have told us that is the deferred tax receivable or recoverable for the period, then that would have been a decrease in our deferred tax. So that will be deducted. Is it clear?
Yes, sir.
So, like I was saying, Since what we only have here is 60,000, that means this ordinary share capital portion has been recorded. It is the premium of 60,000 that is yet to be recorded. So the double entry to correct this will just be to debit what? To debit the suspense account. So the money will be taken out of suspense account and we now credit it to the share premium account. We'll credit it to the share premium account. So then they told us that the directors recommended a 20 kobo per final dividend per ordinary share for the year and to transfer 38,900,000 to the general reserve. Now, note 14. Sorry. Hello, sir. Okay, me. I'm on your classroom. Then, any response me officially be kini. Okay, so for the dividend, 20 kobo per share. Then how many shares do they have? How many shares do they have? We don't know. What we'll do is the authorized the issued share capital, which is 790 million. 790 million. You can use that as 790,000 divided by what? 50 kobo per share. This will give us the number of shares. So this will give us how much? Hello? This will give us 316,000. Now, please, let's pay attention. Look at something. Examiner is trying to play with our intelligence. He's trying to play with our intelligence. Look at the word he used. Directors recommended a 20 kobo final dividend per ordinary share. And don't forget, IAS 10, events after reporting period, explicitly states that proposed dividend is not to be recognized in the books of accounts. So that means this dividend, we are not bringing it into our books at all because it is what? It is a proposed dividend. It is a proposed dividend. And even they now told us that they've reached the resolution at the AGM, they've approved that a dividend of this should be paid. Then we can take that to dividend payable. But this one is still a proposed dividend. So it will not be coming into our books of accounts. Are we clear? Hello?
Yes.
Yes, sir.
Yes,
So
sir.
please, let's always be careful. See the way examiner just played with us using IAS 10. If we did not take cognizance of it now, we'll go ahead and put it in the account. And that will make a mess of our workings. So we leave that at that. After doing all of this, we can now go back to preparing our statement of profit or loss and other comprehensive income. So we have one, revenue. So we have revenue. How much? Notes. There was a note on revenue, note 2, 2073, note 2, 2073, 569. 569. Okay. Then cost of sales. Cost of sales. which is note what? Note 4, cost of sales. Note 4, cost of sales, and with under note 4, our cost of sales is 1038553. 1038553. And this will give us how much as gross profit? Figure, please. Hmm.
135 016
1035
016.
016. So having done that, we go to the next thing, which is our admin expense, distribution cost, and this thing. So we have the first one based on the arrangement here, distribution cost. Distribution cost. And how much is our distribution cost? We cannot take the figure we have here directly because there is an additional information on distribution cost. Note 14, distribution cost. Distribution cost. And who can remind me what's the additional information we have on distribution cost? Distribution cost here is 161,128. Then depreciation on motor vehicle. How much? Remember, they haven't added it. So we are the one that just calculated is 6280. So with this, how much will be our distribution cost? 221408. 221408. Distribution cost, note 14. 221. We have other income, which is this investment income. We have other income, which is this investment income. So let's bring our other income first. But aside the investment income, do we have any other income? Yes, we have. So note 15, other income. So we have investment income. $244,200. Then we have what? Gain on disposal. Remember, we had a gain on disposal in our workings. And how much is the gain on disposal? 23,190. 23,190. So that will give us a total of how much? No, investment income is 65. Oh, 65,246. Because as an income, it would have been on the credit side. 246. Okay. And with you. Hello.
88,436.
88,436.
436.
So other income 88,436. Then we can now bring the distribution costs. Distribution cost will be note 14. This is note 15, which is how much? 221,408. 221,408. Then after distribution cost, we have what? We have administrative expenses. Administrative expenses. As usual, we need to do adjustment to these administrative expenses. Come and say admin expenses. Note 16. Administrative expenses. So in our administrative expenses, we have the trial balance figure to be how much? 173,727. So our adjustment, we have depreciation on building 11,183, depreciation on building 11,183. Then we have what? Depreciation. Okay, no, depreciation of office equipment was fully charged to cost of sales. We have bad debt and allowance for bad debts. Bad debts. The bad debt was how much? 26,450. Allowance for doubtful receivables. Allowance for doubtful receivable is 13,815. Then what else do we have? Impairment of financial assets. Impairment of financial assets. Impairment of financial assets. $12,700. What other thing do we have? I don't think anything else is coming here. So what do we have as summation, please?
237,875.
237,875.
875.
237,875. So that's note 16. Then after that, we have what? We don't have any expense again. So what do we have as our profit before interest and tax?
Six six four 169.
664,169.
169. Yes.
Okay. So the next thing is we bring our finance cost. Finance cost, which is what we have in our notes. Note 9, 41,096. Note 9, 41,096. What will be our PBT? Profit before tax.
Six two three zero seven three.
623,073.
073.
Then tax expense. The tax expense for the year, which we calculated in note 11, 130,408. 11, 130,408. So with this, our profit for the year will be how much?
492,665.
492,665. Then other comprehensive income, we will have what? Other comprehensive income, we have gain on translation of foreign operation. So you know this gain on translation is not a realized gain. That's why we'll take it to other comprehensive income. If it is something we have realized now, we would have taken it to where? So this revaluation reserve of freehold land and building, they did not tell us we just revalued our freehold land and building this year, because in the information we have for freehold land and building, they did not tell us any revaluation. So we'll treat that revaluation reserve as the one that has been existing at the beginning of the year, because at the beginning here, they told us this freehold land and building is as valuation. That means they valued it at the beginning of the year. And remember, SOPL only reports what transpired during the year. So this one, their gain that is for last year cannot come into the SOPL. But with this, what is our total comprehensive income? What is our total comprehensive income?
539,773.
539,773.
773.
Okay, we are done with one aspect of the requirement. We move to the next one. Statement of changes in equity. Statement of changes in equity for the year ended 30 June 2022. So for our statement of changes in equity, you list out all of the equity items we have there. We have ordinary share capital. We have share premium. We have general reserve. We have revaluation surplus or revaluation reserve. Then we have retained earnings and total. So we start with the balance brought forward. The balance brought forward. So what I would have done here is to make the balance brought forward to be 590,000. I know you'll be wondering why am I making it 590,000, because I already calculated. And the one they told us the shares were issued during the year. The shares were issued during the year. So if the value is not in the suspense account, they've added it to this. And that's why I'm taking it out to know what is my balance at the beginning of the year, 590. For share premium, the balance is 142,000. For general reserve, the balance is 109,809. For evaluation reserve, the balance is 80,500. For retained earnings, 231,572. Someone should give me the total. Share issue. What do we have from share issue? Share capital is 200. Share premium of 60. That will give us a total of 260,000. Then profit for the year, or total comprehensive income. Total comprehensive income, or we'll separate it. So in our revaluation reserve, we'll have the 47,108 In our profits for the year, we'll have 492,665. And that will give us 539,773. Then what else do we have? We have
Yeah, the
dividend.
total for balance BF
How much?
1,153,881.
881.
Yes,
So
sir.
the dividend paid during the year, we have how much? 119,880. So we'll take it out, 119,880. We are recognizing this because it has already been paid. It is dividend that is yet to be paid, we will not recognize. Now, the next thing is what? We're told that there will be a transfer to general reserve of 38.9 million. Transfer general reserve 38,900. Where will be the transfer be coming from? From our retained earnings. That's where we'll be transferring from. So that one will be nil. Aside that, I don't think there is any other thing else to be included in this account. So what do we have in summation?
790.
If 790 for me now, this will be 202,000. This will be 148,709. This will be 127,000. So, you know, this gain on revaluation, this gain on translation. The gain on translation the gain on translation is not supposed to come to our revaluation reserve again.
The last one,
How much?
1,833,774.
774. Okay.
Yes.
Retain earning 565,457.
565
457.
457. So for this gain on translation, you know, for them to have this gain on translation, that means they've already added the figures of the translated listing to all of these figures we have here. So it shouldn't be part of this. It shouldn't be part of this again. So what do we have? Please help me correct this. 492,665. Please help me correct this. This total.
Gbogbo ẹ̀ ti dàrú o.
I'm only saying this gain on translation of foreign operation. Yes, it is part of our other comprehensive income for the year, but it will not go to our revaluation reserve. Are you getting me?
Yeah.
178
666.
178
6662.
666.
6.
Okay. That means 6 in 4 places, Abi.
36, 36. Yes, sir.
So that is that. We can now proceed to our. We can now proceed to do the next thing. We are supposed to go straight to statement of financial position. But before we can do statement of financial position, because we have the multiple assets, it is better to do what? It is better to do a statement of movement in non-current assets. Note 17, statements of movement in PPE for the year ended 30 June 2022. So we have land and building, we have office equipment, we have delivery van, and we have total. So we start with the cost section. Cost of valuation. Let me do it that way. Cost of valuation. As at 1 July 2021, we have this to be what? 1065,600. We have this to be 865,800 and 301,400. So please help me calculate the total. Then do we now have additions during the year? Yes, we have additions. There was addition to office equipment. Addition of how much? 82,600. The new one we bought. This one here. Then we also have disposal during the year. Disposal of how much? The cost it was 75,000. But we don't have any fair value, any revaluation or anything. So that means our cost as at 30/6/2022 for this will still be 1065,600. For this will be what, please? And for this will still be 301,400. Please give me the total for this. Then accumulated depreciation 1/7/2021. Since this has been valued, it cannot have accumulated.
7,600.
Which one? This one? 7,000?
600.
I don't understand.
7,600 for total.
How can it be so? You still need total of this opening balance now.
Okay.
So this one, the opening balance is 199,800. The opening balance for this is 120,560. Total, please. Disposal. What is the carrying amount of the asset disposed? What is the accumulated depreciation? To be 75,000 minus the 46,060. 28,940.
The total is 22
22
3 to 800.
3 to 800. Okay, give me the total for this and the total for this. So the depreciation charge for the year, sorry, building is 31,952. I'm with you.
22 4,400.
2240,400. Okay, what about this?
873,400.
873,400. So the next one is what? Depreciation on motor vehicles 6280. Depreciation on office equipment 105,381. Is the total, and the total for each of these also. $180,840. 31,952. These are 36/2022. So we label this A, we label this B, label this C, and we label this D. So to get our carrying amount as at 36/2022, it will be B minus D. As at 1/7/2021, it will be A minus C. Okay? Oh yeah, oh. Hello? I'm
276,241.
coming now. Which one is 2726?
The second one.
2726
276,241.
276241. Okay. Oh yeah, total. Are others not pressing their calculator? Is everybody sleeping already? We have not even started tonight's class.
The
Three two
1st of
zero
July.
356.
3220. Which one?
320356 for the total.
Which one? Is it the last one? The charge, is it charged for the year total?
Carrying amount for 1st of July.
I'm coming.
10656.
Bàbá mo ti ṣe yẹn fún ara mi náà.
291,420.
Tí ṣe tán.
291 lè wọ́n bẹ̀.
Hold on, no.
The office equipment, 1st of July.
48. The last one is 48.
Mo ń bọ̀ o.
9033.
489033.
Yes.
Office equipment mo ń gbọ́. 1st July, how much?
666,000.
666,000.
Then 180,840. Then 192,440. 191,440.
Èwo nìyẹn? Okay.
Then office equipment for 36 is 597,159.
592,159. So what's the total?
597,159.
So yeah, what's the total?
$175,1367.
1751367. Abi?
Yeah.
So we can now go ahead to prepare our statement of financial position. So statement of financial position as at 30 June 2022. So what do we have? So non-current assets, we have what? PPE. Note what? Note 17. 1751. Three, 6, 7. Then after the PPE, what else do we have? We have intangibles. Intangibles. Intangibles, they did not give us any additional information. So we just go with the figure 5,600. Then after intangible, what else do we have? We have financial assets. The financial assets, don't know if it is, but wait, let me see. They told us something about it. If the financial assets, they are said they are equity instruments and they are held at fair value to profit or loss. If it is held at fair value to profit or loss, is most likely held for sale. So it's better to classify it under current assets. Aside that, what else do we have? I might pass for what's it called? None of it is coming. Okay. So this will give us what? 1801967. Then current assets. What are our current assets? We have inventory. And the inventory is how much? 622,812. 622,812. No notes. Then receivables. Receivables must have a note. Note 18. So we can come here and say note 18. Receivables. And what's our receivables? The balance figure. I hope I've not adjusted for it before. Okay, we did not. 579,065. Then bad debt written off. 26,450. Allowance for doubtful debts. Allowance for doubtful debts, 13,815. So what do we have? $538,800. So note 18, 538,800. Then after receivables, what else do we have? We have financial assets. Note what? Note 8 to 31,500. Beside that, what else do we have? We have bank balance. 142,310. Aside that, I don't think we have any other thing left to come to this account. Okay, in the absence of any other thing, the summation is how much? And what will be our total assets? Equity and liabilities. Are we there? Are we there?
Total current 1535422.
1535
422.
122 422. So ordinary share
Yeah.
capital. What's the total asset at 50 kobo each? 790,000.
3337. 389.
3,337,389. Okay, ordinary share capital 790. Share premium, since we already have our statement of changes in equity, we'll just be picking the figures from there. Share premium 202,000. General reserve 148,709. Evaluation reserve.
Sorry, adjust the board down, please.
8,500. Then retained earnings 565,457. Retained earnings 565,457. And the summation of it all is 1786666. 1786666. Having bought all of that, we can now go to, we have non-current liability. 3% redeemable loan notes. It's 43,000. Deferred tax. Deferred tax according to notes 12, 112598. 112598. Aside that, I don't think we have any other thing there. So this will give us how much? Current liability. Trade payables. 353,846.
Total non-current assets, non-current liability, 955,598.
Yes, 955,598. Okay. Bank balance. This bank balance will come last. I'm coming back to it. So in the absence of others, we have what? Accrued interest. Accrued finance cost. Note what? Note 10, 26,333. Accrued finance cost. Note 10, 26,333. Then we also have what? Tax payable. What's the current year tax provision? That will be our tax payable for the year. 143,552. Then bank balance. Sorry, bank balance should be here. 49,950. 49,950.
Sir, are we not adding the FATA? Oh, we've
We've
added it,
added
sorry.
subvention, please.
523,731.
523, 571. What do we have as summation? Hope we did not leave anything out. I don't think so.
Balance.
Okay. What do we have?
Oh, this last one is not 523. It's 573 681.
573681.
Yes.
What do we have as the summation? What do we have?
What's the balance now? 33. Oh no, for balance.
What's the total?
3315945.
33159.
545.
3315945.
Yes.
And what is the difference?
Difference is 21444.
22144.
21444. 21444.
21444. That's the string figure. 21444. I just hope it is not a casting error. Ooh, 21444. I don't have anything similar to it here. Mhm. Please confirm all of these figures, so please.
Which one is this in USFP?
Is all of it we need to confirm, but let's see.
First figure for the, maybe it's not, it doesn't matter. Sha. For the
Which one?
statement
Which
of
one?
changes in equity, the total figure is 786,
Huh?
not 78666. The total for changes in equity is
No.
1786746.
786.
746.
746.
Yeah.
One 786 746. Okay.
Yes.
Have you tried it in both ways? I mean, taking the total of each of these column and taking the total of the total column also.
Abi, wait to the what's the value for dividend again?
119,880.
Okay.
Help
So
me,
sorry,
help
it's
me calculate this again.
1,786,666. Sorry.
Help me It's 666.
It's 1,666. Yeah.
Help me calculate that retained earnings again.
Yeah, the figure is correct.
Okay, okay. We're coming now. Mm, Sorry, what do you say is the difference again?
Two, two, one, four, four, four.
21,437.
Is it 437 or 444? Check it again.
Okay, 1 minute, please. Oh, shoot. So, um, okay. Yeah. Okay. Are you guys there? Hey,
Yeah,
hello.
Yes.
yeah.
Yeah. So, don't mind me. So, information were much, so there was an oversight. So, if you look at this place, we were told that there was an over provision of 25,664 in respect of the income tax for the previous trading year, right? Now, this this over provision, what does it mean? It simply means in the previous accounting year, what they provided for the tax liability is more than what they actually paid. Abi? Hello?
Yeah.
So let's say this is tax payable accounts. When they provided for the year, they provided 50,000, they would have credited as the tax payable account with the 50,000 and debit SOPL with the 50,000. Now that was the balance at the end of the year. At the beginning of the next year, they would have begun the year with the 50,000 balance. But when they wanted to pay, they ended up paying just 45, they ended up paying 47,000. So what they would do when they pay is credit bank, debit the tax payable account, 47,000. Meaning we still have a 3,000 balance left in the account. Are we getting it? That's the over provision. So if they now make current year provision of, let's say, another 50,000, current year provision, it will just be 50,000 here. What we'll have as the balance carried down here will now be what? Instead of it to be this thing, 50,000, it will be how much? It will be 53,000. Are you getting it? Hello.
Yeah.
Okay. So what I'm trying to say in essence is this over provision. It is supposed to reduce what we have here as the provision for the year, like what we'll now be having as our payable at the end of the year. Do we understand? You know, at the point where they are making payments, we would have credited. Okay, so we have I'm coming. Seems like when we make provision in the first year, 50,000, when we wanted to pay, we realized that we have over provided. Ideally, what they were supposed to do when they realized that they have over provided was that they should have taken it out of the payable account. That figure should no longer be payable, right?
Yeah.
So the double entry they should have passed for this over provision should be to debit the tax payable account with 25,664 and credit what's it called? Credit SOPL with the 25,664. So we have credited SOPL with the 25,664 by removing it here. Are we getting it? But the debit we were supposed to have to the tax payable account, we did not do it. Are we getting it?
Mm.
Let me redo it this way. Just like I have said here, we have tax payable accounts. And we have bank accounts. In year 2012, we make provision SOPL 50,000. Balance carried down 50,000. In year 2013, we would have started the year with the same balance. Balance was forward 50,000. Then when we wanted to pay, we paid 47,000. Bank 47,000. So you know that means we have over provided by 3,000. If our payment has actually settled all of what we have. Now, if our provision for the current year now is supposed to be 50,000, because we already have an excess of 3,000 still left in this account, what we should only bring here should be, I'm saying if it is still the same 50,000 we want to provide for the current year, our SOPL now, because we already have a 3,000 left in this account, should only be 47,000. Where am I getting? Or don't let me use the same figure so it will not be confusing. So let's say we calculated our provision for the current year, and our provision is supposed to be 55,000. Now, instead of us providing 55,000, because we know we have already over provided in the previous year, what we'll only provide, we say 55,000 is what we are supposed to have as a liability at the end of the year. So if we say balance carried down 55,000, then what should go to our SOPL will now be what? This will be 102. 102 minus 50 will give us what? Will give us 52. And we are having 52, which is as a result of the 55 we are supposed to have normally, minus the 3,000 we have in excess before. So what am I saying in essence? Even though they wanted to provide for, even though the tax expense estimated for the year is 143,552, because they over provided in the previous year, what should go to their SOPL should have been the 143,552 minus the 25,664. I don't know if we understand.
Oye, bákan.
Okay, let me re-explain it this way. Let me see if this way it will be better. Yeah. So when we made the provision for the year, what we would have done is debit SOPL, credit credit tax payable accounts. Abi? So let's say we made provision of 100,000. When we wanted to pay, we did our tax computation and we realized that we are only to pay 88,000. What do? We debit our tax payable accounts with 88,000 and credit our bank with 88,000. Now, having done this, which means we have settled our tax liability, we are not supposed to be having any balance left in the tax payable account, right or right? Since we are not owing the tax people for that transaction again.
Mm.
Do we agree?
Yes.
But there will still be a 12,000 balance left in the tax payable account because of this. Because this is how the tax payable account will look like now. Balance brought forward 100,000. Abi? Bank payments 88,000. But because we know we are not owing these people again and we don't want this account to show any balance, what do we now do? We'll now say debit this account with SOPL of 12,000, then credit SOPL with the same 12,000. So this credit to SOPL, this debit tax payable with 12,000 and credit SOPL with 12,000 is what we are doing here, which make us deduct this 25,664 from SOPL. Since they've made the payment during the year, what they should have done is debit tax payable with 12,000, then credit the income tax over provision account with 12,000, so that figure will be part of what we'll be having in our trial balance here. But since they did not do it, as we are deducting the money from this, we should also be adjusting the tax payable account, meaning we are supposed to have note 19, tax payable, which will now be what? Current year provision. Current year provision which is how much? 143,552. Then over provision in the previous year over provision 25,664. Because you see, the assumption we will use here, or let me say the explanation for this, will be that since they did not recognize that over provision in their SOPL, then the best explanation for it will be that they actually paid the tax authority this 25,664. Just that they paying the tax authority that 25,664 create an overpayment with the tax authority. Are we getting it?
Yes, yes.
So that overpayment now, it will reduce what we are now supposed to create as provision for the current year. It will reduce what we are supposed to have as over provision for the current year, as provision for the current year. So I'll come here, note 19, tax payable. It should be 117 888. However, that's not all. You see, this gain on revaluation, this gain on translation of foreign translation of gain on translation of foreign operations. Now, the gain on translation of foreign operations, it will also be part of our equity. You know that gain, even though they have not made it, they still have that foreign operation. It's still part of what they own. For finance students now, you know, we've done foreign subsidiary, and the gain on the revaluation simply means in the gain on the translation, it simply means our assets and liabilities are now being taken at that higher value, which is inclusive of that gain. So the gain should also be part of our foreign our reserves here. However, we should create a separate space for it. So I will adjust this share premium. Share premium gain on translation. So share premium initially was 142,000. This one. Then share issue, they made 60,000 on this. Then during the year, they made 47,108. 47,108. So what do we have? So we will have to correct this. That's a mistake on my part. Everything we have in the total comprehensive income should come here. 539,773. And this will now be 202,000. Then this will be 47,108. And with that, this will be what? Please help me recalculate this. Hello?
We are calculating everything.
Okay.
One 1,833,774.
1,833,774.
774.
Okay. So we'll come here and say gain translation of foreign operations. How much is that? 47,108. And that will give us 1,833,774. 1,833,774. So with that, what will be the total?
What's the balance? What's the balance? Total current liability 548,017.
948.
548,017.
548,017. Okay.
Three three three
333.
7389.
389.
Yes,
So
so
that is that. Huh?
to balance. Thank you so much.
Yeah, it has balanced. But at the same time, so one thing we must take note of is the items we have in this extra balance has already undergone double entry. So it should only be taken, we will only be using it once in our presentation of financial statements. But those in the statement of financial, those in the additional information, they haven't been treated. So we'll be using it twice. And if you look at all of it, we treated it twice because the double entry is yet to be, because we need to treat the double entry for it. Is it clear?
Okay.
Me, I
Yeah.
don't understand.
What I'm saying is, you see, everything in this, before we can prepare the trial balance, we must have done double entry for those transactions. It is transactions we've done double entry for that we usually do, what's it called? That we put in a trial balance. What do I mean? It is after you've done subsidiary books, subsidiary books, you take the transactions to their ledger, you balance the ledger. That's when you can extract the trial balance. And when you do all of this, double entry would have been passed for the transaction, right? So any transaction you are seeing in the double entry, in the trial balance, the double entry has already been passed. All you need to do is just show it in the statement of, in either the statement of profit or loss or statement of financial position. But you will only be using that information once. But anyone in the statement of financial position, in the additional information, sorry, that one, no, this thing, they haven't done anything to it. They haven't treated the double entry. So you have to treat the double entry. Is it clear? Is it clear?
Benny.
Okay. So that is that.
So I can send the screenshot of the notes.
Yeah, sure. I'll definitely send the screenshot of the notes.
Thank you.
I'll send the notes itself and every other thing. So
Okay.
I think we'll have to call it a time here because I know most of us still have class tomorrow. I would have loved to do one more question, but
Yeah.
we can try the question one in this other material. It's also a bit trickish, but let's see what we can do with it. That will be all for tonight. Maybe we will have another night to look at one more question and we'll call it a time. Thank you very much for your time.
I too. Thank you.